some of the latest guidance that's been coming out about that. So we'll start with Chris and Valerie, and turn it over to Chris to start off. Thanks. Chris, you gotta unmute yourself there, if you can. No, Johanna, can you unmute Chris? There you go.
I did.
Okay,
yeah.
sorry about that. I think I'd have this down by now. Good afternoon, everybody. As Rich said, Valerie and I are going to talk briefly about, I don't know if it's the latest and greatest, but it's the latest as far as we know. But our practice and our counseling with clients has really now turned to return to work issues, and how do we get the employees back off of their furloughs and back to work. And what's complicated that a little bit is the availability of the federal unemployment benefits. I think last time that we were together, the PUA, the Pandemic Unemployment Assistance, the federal program, wasn't quite up online yet. That is now available online, and you can read all about that if you'd like at the Department of Labor website. They have a special, I think if you just search Connecticut DOL PUA, you'll come up with a whole lot of information. But there are essentially three programs that are complicating return to works, and they're all federal benefits. We've got the FPUC, the Pandemic Unemployment Compensation Program, and that's the one that everybody knows about and either loves or hates, the $600 additional weekly VIG for someone who's receiving $1 of state unemployment benefits. That's still in play, and will be till the end of July and May. There's some talk or chatter maybe that might be extended beyond the end of July. But the newer one that we didn't get a chance, I don't think, to talk about last week in any detail is the PUA and the Pandemic Unemployment Assistant, which is now the federal program that is bringing relief to individuals and self-employed independent contractors that were not otherwise eligible for state unemployment. So the difference between that and the FPUC, the FPUC $600, is that the PUA does require a separate application. You can fill it out on the Connecticut Department of Labor website. It is a federal program, but the application process is there. And to be eligible for the PUA, as I said, you either need to not be eligible for state employment because you're self-employed, because you're an independent contractor, because you don't have sufficient work history, or and there's a long 10-item laundry list of reasons why someone might be eligible for PUA based on sort of COVID-related reasons. And that's the one that is starting to complicate things, because someone that has exhausted state benefits or is not eligible for benefits might be eligible for this Pandemic Unemployment Assistance if they have. And again, I'm not going to read them all to you, but they're basically 10 different categories. If you've been diagnosed with COVID-19 or you're experiencing symptoms of COVID-19 and seeking a medical diagnosis, there's a member of the individual's household has been diagnosed with COVID-19, or you're providing care to a son or daughter whose school is closed. Sorry, I'm being Zoom bombed by my dogs. Shut that door, apologize. So that federal program is now in play, and it's complicating, individuals' return to work, because a lot of folks, when they're now being returned, they're saying to their employers, well, A, I'd like to continue on unemployment because I don't mind this $600 extra charge. B, am I entitled to unemployment based on the federal benefits? And what we're advising clients is if you've returned your employees to work and they're refusing to come back to work, initially try to dialogue with them, explain the situation, communicate with them, and let them know that you've got a return to work date for them. And a job for them, and that by not returning to work, they could jeopardize their benefits and they could jeopardize their employment. Some of them may be eligible to stay out. They may be eligible to stay out under that federal program if they've exhausted their state benefits and they're eligible for the PUA. The other big issue in relationship to the unemployment benefits that are now available is, you may all remember, it seems like years ago, but April 1st was just over a month ago when the Family First Corona Response Act became effective, and the benefits that attached to that, both the paid sick leave and the extended family medical leave. We're seeing a lot of questions about, what happens if we bring an employee back whose son or daughter whose school is closed. Do we bring them back and do they just go out on leave again? And the answer to that essentially is yes. I just got off the phone with a client before this call, and she was asking, well, if I bring them back and she says she can't come back because she's got to take care of her son or her daughter and she's going to resign, doesn't that sort of end the conversation? And my response to that was, no, not really. If you've got an obligation to post in your workplace the FCRA rights, and B, you need to tell that individual, well, hold on a second, before you resign, let me tell you what's available for you to come back. And so we've had on a number of occasions counsel clients to bring employees back to work and then immediately place them on extended family medical leave. They are no longer eligible for unemployment if you have a job ready and available to them, but they still have that right to exercise the rights to FCRA. And so in a lot of situations, we're seeing employees coming back just temporarily and then going right back out again on the Family First leave. And as you probably recall, that's paid at 2/3 their regular rate. It's available for up to 12 weeks, and you get a tax credit on the back end of that. So what we're seeing is a number of folks going back out at least till the end of the public school year. And then the question is going to become, well, what happens over the summer? Because the guidance or the statute talks about places of care. So it's not just schools. I mean, if there's a summer camp or a place of care over the summer that's closed due to COVID, that extended family medical leave could continue. So that's sort of just a quick tip on the unemployment world and how that's impacting return to work. The other issues that we're dealing with before I turn it over to Valerie to talk about, some safe workplace guidance is, we're seeing a lot of questions about, can I test employees? Can I, require them to take a COVID test, or can I do temperature checks? And the answer to that is yes, you can in most instances. Temperature checks are becoming more and more prevalent, and even COVID tests to the extent that they're available. We have some clients that have set up sort of their own, they bought their own testing, and they're setting up a program where they're doing the COVID test prior to bringing people back to work. And essentially that's as a result of the EEOC loosening their restrictions under the Americans with Disabilities Act, allowing employers during the COVID-19 crisis to do more medical exams and or medical inquiries. Obviously historically you couldn't do that. You couldn't ask someone to disclose their confidential medical information. But now, because the EEOC has declared that COVID-19 is a direct threat to the health and safety of employees and their co-employees, those types of inquiries are allowed, and they probably will be allowed for quite some time. So that's just a quick summary of some of the return to work issues. We talked a little bit last week about some of the return to work plans, and Valerie's got some updates in terms of the government Lamont's return to work guidelines, and I'll just turn it over to her at this point.
Hi, everyone. As Chris mentioned, I'm going to be talking a little bit about Governor Lamont's new guidelines that he issued on May 8th about the prospect of opening some businesses on May 20th. I think the last time that we were all here, we were just talking about essential employers and what types of things you should do. So you'll see there is some overlap between the safety measures that essential employers were told to take and now the guidelines for businesses reopening on May 20th. Pursuant to Ned Lamont's order, so far, hair salons and barbershops, museums and zoos, offices, outdoor restaurants, retail and malls are all included in this new guidance about what can be open on May 20th. It is the individual business owner's option whether or not they want to open. This, of course, if you don't feel comfortable or you don't think that you're going to be able to get your business in accordance with these guidelines, then you shouldn't reopen. You don't have to reopen. And all businesses that would like to open on May 20th are required to self-certify with the Connecticut Department of Economic and Community Development online. There will be a link to the certification process that it hasn't been issued yet, but every business who plans to open on May 20th will need to do so to certify that they've reviewed these procedures that are relevant to their area and that they have put into effect these safety measures in order to make it safe for both their employees and any visitors or customers. Pursuant to the DECD, they want businesses to limit their capacity to 50% for those that reopen. There isn't a lot of detail about what that means, but employees who can work from home, they're encouraging employers to allow them to continue to work from home so that you're minimizing who actually needs to be in the office when you reopen or the business when it reopens. And included in those groups, like the high risk individuals and those over age of 65, those are probably a good place to start with who should be staying home and being safe and who should be in the office. Again, there are different guidelines for each of those industries that I mentioned, but today I'm going to focus on offices because I think that in a lot of industries there are offices and it covers a lot of ground. But again, if you have questions about your specific industry, feel free to reach out to one of us at the firm. We can help you determine what you need to do. For almost any business, it's important to have a written policy about how your workplace is going to look when you reopen. Appointing an administrator to be in charge as kind of a point of contact for employees to contact about questions they have prior to opening and also when you're open, just someone who really knows the guidance, who's going to help implement it. That'll help with the transition process. There are a lot of protocols on OSHA and on the CDC websites that'll help you with how you need to now the cleaning of surfaces and different things in your office. It's pretty strict and there's only certain ways to clean it that are approved. So you should review that and start to get your office areas equipped with these new cleaning supplies prior to opening. They also require every office to do a deep clean before you allow all the employees back. They recommend developing a checklist that lays out who's going to be responsible for the different cleaning measures and keeping track of making sure everyone's in compliance. It is the employer's job, I think we talked about this before, that to provide masks for employees or to visitors who do not have them. So you should take this time in the next few weeks before you open to make sure that you do have the appropriate number of masks that you estimate you will need so that people who come are protected. Prior to reopening, make sure all the your lobbies, entrances, bathrooms, kitchen, door handles, everything is wiped down and cleaned pursuant to the guidelines. And in your policy that hopefully you can send out to your employees prior to opening, make sure to include that you are following the Connecticut guidance on masks and that they should be arriving to work and moving around the common areas using their mask. If you're in an area that you have segregated spaces, of course, employees can remove their masks once they're in their office or in their designated area. However, if they're moving around common areas, entering, exiting, that sort of thing, then they should have them on. And the only exception, of course, is for those individuals who are not able to wear masks due to a medical condition. As you start to look at your office again, it's going to be a little different going back. You need to rearrange your desks if necessary so that they are at least 6 feet apart. Stagger them where necessary. If you can divide your work spaces into zones, that would be helpful so that employees can kind of remain in one area instead of having employees, they can use any printer they want, tell everyone they should use this printer in this part of the office and try to minimize the traffic of people just milling about. Make sure that you're stocked with disposable wipes and other cleaning products that you can place in the area where shared things are unavoidable, such as in the kitchen. If you should have things to wipe down the handles of refrigerators or near printers or computers that are shared. In-person meetings, again, should be avoided as much as possible. The new guidance limits groups to a maximum of 5 people, and even with that, you need to socially distance and have masks. And we discussed this last time, but if you have a business with multiple shifts, think about work going from 1 to 2 shifts to 3, and keeping those shifts the same so that the same people are interacting with each other each day. Try to also stagger start and end times so that there isn't like a mass exodus out of work where people can't avoid being near others. And also breaks and lunch breaks and other things, try to stagger those as much as possible. And if you don't need to have a break room or a lunchroom or cafeteria, consider closing that and just having employees bring their lunch or eat in their designated work area or their car. The CDC also recommends increasing ventilation rates and increasing the amount of outdoor air that circulates through your offices. Fortunately, the weather is hopefully going to be pretty nice coming up this summer, so just opening windows and getting gusts of air through the office will help circulate and ventilate. One thing in the guidance that we hadn't seen before is just it specifies that landlords are responsible for the common areas in their buildings. So if you are in an office building that's shared, you really just should focus on making sure your floor or your office is in compliance, and it is the landlord's responsibility to take precautions regarding the lobby, the elevators, having hand sanitizer in those areas, arrows where necessary. So that is their responsibility, and you as a tenant are responsible for your own floor, your own kitchens and lobbies if they're within your floor. Again, these were just sort of the basics about offices based on the guidance that Governor Lawman issued, but if you have specific questions about another industry or your business in particular, feel free to reach out to one of us. And with that, I'm going to hand it over to Rich, who's going to talk about PPP and SBA.
There we go. Got me? Okay. Good afternoon, everyone. Following up on what Valerie just said, there's a lot of changes that are going to be related to a safe work environment. And last time, I know we spoke about the CARES Act and the interplay between the CARES Act and the SBA loans. But I want to kind of go over that again briefly, because some of that is applicable to any necessary capital improvements or upgrades to your office or to your restaurant or your business that's necessary as a result of these changes that are going to be required to provide a safe workplace. So back when we met last, we talked about the CARES Act, and what you hear about all in the CARES Act is the PPP program. But one of the overlooked provisions of the CARES Act was a section 1112, called the subsidy for certain loan payments. And that's if you were an existing SBA borrower, the SBA would forgive 6 months of principal and interest on your existing SBA loan. What's interesting is that also applies to new loans that are made in the next 6 months from the date the CARES Act was started, which was back in March 27th. So from March 27th till September 27th, a new SBA loan, whether that be a 7A loan program or a 504 real estate program, or even a micro loan, which is up to $50,000, you can use that for these types of purposes. And the SBA will pay 6 months of principal and interest on those new loans. So that's a good opportunity for you if you're in that position and you need to make some capital improvements. There's some source of funds there. We're also hearing through Middletown and through the Middlesex Chamber of a potential loan program with the City of Middletown that will be rolled out, and we're waiting on the Common Council of Middletown to start, going with that. And there's another source of funds there. So there's going to be these different sources of funds that might be available to you that you could use for these types of capital improvements. That differs from the Paycheck Protection Program, where you're very limited to what you can use it for, primarily payroll costs, and also some limited 25% for things like utilities or rent. And so since the last time that we've talked, there's been a lot of consternation, a lot of concern by the business community about how the eligibility for the Paycheck Protection Program was rolled out, and whether or not you're going to be held liable for the repayment of that if what you represented in your loan application might be different from what you know today, or how the new guidance has changed, what your potential uses are. And Rick will talk more about the ramifications of that. But you have until May 14th to actually, change or amend your application, or actually return the funds if you feel that what you represented in your application may not be correct now, given the hindsight of some new guidance. And as far as the payroll costs go, some of the questions we've been answering related to self-employed individuals. If you're a self-employed individual, perhaps you have a small LLC with a few employees, and you either you take a paycheck or don't, maybe just get paid on as draws, you can still use the PPP money to pay yourself a salary, as long as it's not over $100,000 and you kind of annualize your payments. Again, it has to be in the next 8 weeks from the date that you receive the funds, the PPP funds, through 8 weeks period of time, but that is available to self-employed individuals. It's not available to 1099 contractors or independent contractors. Those are separate and not included in the PPP funding, at least for the forgiveness. As far as seasonal employees go, the SBA came out with some guidance about going back and looking at your application. You can use your season to calculate that calculation of your employees and how many full-time equivalents you would have. There's still some disconnect there as to whether or not you need to use the funds now over the next 8 weeks from your receipt of those funds, or if you can wait till your season actually opens. As it stands right now, you have to use the funds now, and I know that's tough for a lot of businesses that maybe you have a seasonal business and you're not open yet, or if you're one of these businesses that are not open at all yet and waiting on this May 20th deadline. You've been sitting on these funds for a couple of weeks now. So, we're still waiting on guidance from the SBA. The SBA regional director was on with Congressman Larson on a meeting that the chamber hosted last week. I think the indication is that there will be some guidance coming out. They're supposed to have it out before the 14th, which is only a couple days from now. So hopefully any day now we'll see some new updates on that. Hopefully, we were hoping to have some today, but I don't think they came out in time. And then finally, the last thing I'll say is, this question of using the PPP funds to pay for employees where you've offered them back their job, offered them back their employment, and they've refused for one reason or the other, whether or not that's going to be held against you in reaching your goals under the PPP program. And Wendell Davis said at his meeting the other day with Congressman Larson, and also in the guidance that's been issued by the SBA, that won't be used against you in terms of calculating your full-time equivalencies. So you can use those funds to hire another employee to fill that slot. You don't have to hire your former employees back if you've offered it to them and they refuse to return to work. And they have other complications, as Chris was alluding to earlier, about loss of payroll, unemployment benefits in that circumstance. So that's a really high-level overview of kind of an update of where we were from 2 weeks ago. Again, waiting on further guidance from SBA. Hopefully we'll get that soon, and you can always reach out to any one of us with any specific questions. I'm going to turn it over to Don Seifel for some tax discussion on those issues. Thanks. Don.
All right. Good afternoon, everybody. For those who participated last week in the webinar, if you remember, I was talking about or pondering the question of if your PPP loan is forgiven and it's clear that under Section 1106 of the CARES Act, it does not result in the recognition or realization of any gross income and it's tax-free, would the IRS require under either Section 108 or 1017 of the code on the standard debt forgiveness provisions and the regulations promulgated thereunder, do you have to reduce your NOLs or do you have to reduce your depreciable basis in property or and the like? And Thursday on April 30th, the IRS issued IRS Notice 2020-32, and the result was actually a little bit more draconian than that. And what IRS Notice 2020-32 provides is that to the extent you use PPP loans for otherwise deductible expenses, i.e. payroll, rent, utilities, and business interest, those deductions are now not going to be deductible to the extent that PPP loan is subsequently forgiven. So that's the application of the longstanding no double benefit, no double dipping rule. And the IRS basically relied on the regulations promulgated in Section 265, which basically denied deductions attributable to exempt income. So they have longstanding case law and regulations to that effect. So to the extent the IRS ruled that way, it kind of took the proverbial bloom off the rose. People were thinking, hey, great, I got my PPP loan, I got money to pay for payroll, and my cash flow concerns are now alleviated. I was going to be able to fully deduct it, and now the loan's forgiven, and life is great. Well, not so much. So, the old two adages that come to mind is, no free lunch, and you can't have your cake and eat it too. Understandably, but now it poses a lot of problems for business owners. So a lot of our clients are now asking, well, what do we do now? Some are, anticipating or considering, by Thursday, May 14th, to either recertify their criteria or give the money back. And the SBA said to the extent you give the money back, it will be deemed to have, the PPP loan application was deemed to be made in good faith and no harm, no foul. Some folks are still considering how to maximize the use and the loan forgiveness. Other folks are just, up in the air. So some immediate observations. If you're a C Corp and you have that loan forgiveness not resulting in deductible expenses, you got a combined federal and state income tax hit of 30%, 21% federal, 9% state. For individuals who are business owners in pass-through entities, that's LLCs, partnerships, S-corps, the combined loss of tax deductions could result in a 44% marginal rate, 37% highest federal rate, and 7% state rate. So this is one rare instance where if you're a C Corp, it actually may be advantageous to be a C Corp versus a pass-through. A lot of folks, after the 1986 legislation, kind of converted to S Corps and they were used to having that pass through with a lower individual rate. Well, now we have a distortion or a flip of the rates, and C Corp rates are actually now more advantageous. If you're a C Corp and you have accumulated NOLs going forward, well, you can use those NOLs to shelter those otherwise non-deductible expenses. So that should mitigate or alleviate some of the burden there. If you're a pass-through entity, again, LLC, partnership, or S Corp, or even a C Corp, you may project a current fiscal year loss this year. The problem I see is that no one can really forecast with any degree of certainty or predictability, A, what your future expenses will be, and more importantly, what your future revenue will be. And if you're going to certify for that loan forgiveness, that has to be done probably before you're going to close out your year-end books. So it's kind of a shot in the dark, and a lot of advanced planning or thought has to be given. So if you have a loss, you may be able to minimize that non-deductibility, but you're not going to know that until you really close out the books in either December, January, or whatever your end of your fiscal year is. For our professional corporations, engineers, architects, lawyers, accountants, and physicians, we have traditionally always zeroed out very effectively our taxable income to, result in no application of any federal or state income tax. Well, now if these deductions are now no longer deductible, you're going to be forced to be in a tax-paying situation, and you're going to have to repay a portion probably of that PPP loan. So you got to look at your 2020 cash flow considerations as well as your first Q1 and Q2 cash flow considerations too, because you're going to be ending up paying the PPP loan over an 18-month period and paying some federal and state income tax to boot. Now, obviously, this is not what we think Congress intended, and there's been a huge uproar. Senator Grassley has already proposed legislation before the Senate to repeal the IRS rule in IRS Notice 2020-32. And we understand that it has substantial Democratic support, but as we all know, Congress moves indefinitely slow, and there's no certain respite that we can rely on. So for now, assume that these deductions are not going to be deductible if that loan's forgiven, and just sit tight and let's just see what Congress does. And I don't foresee the IRS changing that position. That ruling was published by some rather high ups in Treasury. And again, they have solid regulatory and case law backup for that. So for now, I think we got to assume that those deductions are gone, and we got to just make the best of it. And that's about the only update I have really that I think is applicable. So I'm now going to turn it over to Rick.
Thank you, Don. Good afternoon, everyone. I wanted to touch briefly on 3 points this afternoon. The first being potential fraud claims under the Paycheck Protection Program. The second being business interruption claims. And the third being potential liability for businesses as they reopen, starting with some businesses on May 20th. With respect to potential fraud claims and both criminal and civil penalties under the Payroll Paycheck Protection Act, we're already starting to see, with regard to the certification, that the government is taking a very close look at people who were claiming that they were eligible for these monies. I'm sure everyone saw a few weeks ago that some high-profile, publicly traded companies and very well-off companies, the Lakers, Shake Shack, other big businesses, were sort of publicly shamed into giving back the loans that they had received under the Paycheck Protection Program. In response to some of those issues, the SBA and the Treasury issued some guidance saying that they were going to start to look at companies that had gotten more than $2 million. And they also, gave some guidance as to who's really eligible. They said if you're a publicly traded company, if you've got a certain amount of liquidity or you're able to get loans from other places, that you should really look for that first before you come to the government for these potentially forgivable loans. Under the certification, you're required to attest to certain things before you apply for the loan, including that your company is suffering from economic uncertainty, that you're going to use the money for certain purposes, et cetera. It seems now that the there was as Rich had mentioned earlier, there's a safe harbor provision, which allows companies to return those monies. Originally, it was by May 7th. The government then extended that safe harbor to May 14th. In the interim, they were supposed to issue some guidelines so that people would have a better understanding of what exactly it was that they were supposed to certify to and what it really meant to be eligible for these loans. That guidance has not yet been issued, and now May 14th is only 2 days away. If you do think that you improperly, either negligently or fraudulently may have certified to your eligibility, then you have until Thursday to give those monies back with essentially no questions asked. You don't need to give any reason, and you will have been deemed to have made the certification in good faith. So as Don said, no harm, no foul. What's happened since even since the last time we had this webinar, there have already been 2 criminal prosecutions started. One against an individual in Massachusetts and another in Rhode Island. So 2 New Englanders who have already been arrested by the Department of Justice for making fraudulent certifications. Essentially what they did, I think there were restaurants involved. Both gentlemen claimed that they had businesses which employed dozens of people, several locations, and both of those individuals were turned to their businesses had either shut down prior to the COVID-19 situation, or they were not, not operating at this time. And one of them had asked for about $500,000, and the other one was, I think, a little over $100,000. So we can see that even though the government was originally claiming that they were only going to audit companies that had gotten $2 million or more, in the case where there's a reported fraud, and in these instances, I think there was a whistleblower, someone who notified the local police department. So once there's a notification made, they're going to be looking at loans probably of any amount. And certainly if they find that there's some criminal activity, such as was evident here, and really blatant fraud, they're not wasting any time. It's amazing, even in some of the articles which I read about this, they've gotten emails already from these individuals as to, looking into the scheme and saying, well, we could do this. Well, what if we say that we have X number of employees, things of that nature. And the government is, it's the full weight of the government will be bearing down on you if this happens. This is the Department of Justice. There's specific task forces that have already been put in place. Connecticut is cooperating or has started a task force with the federal government to specifically look into COVID-19 fraud of all types, not just with the payroll or paycheck protection program, but price gouging and any kind of schemes or scams related to COVID-19. So be very careful. If you think that you may have improperly certified, I suggest that you speak with your bank or your accountant or your attorney to see whether or not you should really be thinking about giving those monies back prior to May 14th. My guess is that since there has been no guidance to date, that safe harbor may very well be extended once they do issue some guidance, but we'll know that they'll have to do that before May 14th. The other thing that's going on is federally, there's a House Oversight Committee, which is made up of Democrats and Republicans, and that committee has started sending letters to businesses. And these are larger, again, publicly traded businesses that sort of stand out in having taken these funds when they probably weren't eligible for them. And the government is asking people to return that money by the May 14th date. And if they don't do it, they have to provide all the documentation to support their certification by May 15th. So they're not really giving people any time to sort of get their ducks in a row if they haven't done so already. So what we would recommend is for anyone who has received any of these monies in any of these government programs, whether it be through the CARES Act or some other emergency money, is to make sure that you keep very good track of the reasoning behind your request. Make sure that you have a good documentation as to the business losses that you may have suffered or the economic uncertainty that you anticipated happening over the course of the pandemic. And also make sure that you segregate the funds, perhaps in a separate account, so you're sure that you're using them properly once you start to pay them out for payroll or other eligible purposes, and that you just keep very good track and good documentation of everything that you do. It's a very serious issue, and The government's taking it seriously. There's trillions of dollars at stake here, and they're really, pulling out all the stops. The second thing I wanted to talk about briefly, and we may have touched upon this a couple of weeks ago, but it's worth repeating, is business interruption insurance. Under either your general liability policies or all risk policies, many companies have provisions which allow for, usually in instances of physical damage to property, where you're allowed to recoup costs of lost business. So if you're forced to shut down due to a fire or a flood and you lost business, which you can document your monetary losses, then there's an argument that you have insurance coverage for those monies. As with all insurance, there's several exclusions, including things such as bacterial infections, viruses, other pollution exclusions, other things of that nature. So at first blush, given that this is a pandemic and there's really no direct physical damage to property, such as a fire, the initial reaction to people was that business interruption insurance would generally not be applicable in this situation. However, there are already close to 200 lawsuits that have been filed throughout the country, including, I think, 6 in Connecticut already, where people are claiming that, yes, this does fall under business interruption insurance. The potential contamination of the premises should be treated as physical damage, and this is no different than any other type of business interruption loss. These things are all going to have to play out through litigation. They're going to be decided by the courts. But the important lesson here is that if you think that you have a business interruption claim, you should speak with your insurance broker and put your insurance company on notice sooner rather than later. There's also, in several states, there's been legislation, which is, at least the legislation hasn't passed, but it's been proposed, where we'll require insurance companies to honor these business interruption claims, even though they might not, they're not exactly complying with the letter of the law or the particular letter of the policy. And there's also some legislation in the works to set up a fund, which would be sort of a joint insurance industry government fund, similar to funds that were established after 9/11, where companies may be able to make claims. So the most important thing is, while this is all working itself out, over the course of the next several months and years, what you don't want to do is find out that you were actually eligible under a policy, but you didn't do the simple thing of putting your insurance company on notice. And so make sure you go ahead and do that. And the third thing, which I'll discuss briefly, and there's really no good answers to this, but just something to think about. Many businesses are concerned about potential liability once they reopen. And the potential liability would stem from reopening your business. A customer comes in and then they claim to have contracted the coronavirus or COVID-19 from being at your premises. Several business industry organizations and businesses have been lobbying the government, both state and federal, for some type of immunity, or indemnification provisions where people would not be held liable, if businesses would not be held liable if someone were to get sick. But as far as I know, none of that has passed yet. So just like you can be potentially liable if someone trips and falls in your place of business, or if they otherwise get hurt when they're visiting your premises, there's a potential that if someone were to contract the disease while at your place of business, that they could bring a claim. So the best thing to do in order to have a proper defense against that is to make sure that you carefully follow the certifications and the requirements that Governor Lawman has set forth. That when you certify, before you open your business, that when you certify that you've complied with those requirements, that you've actually complied with them, that you keep a record of having done that, and that you do everything you need to do to follow the guidelines to keep your business premises clean and as disinfected as possible, that your customers and your staff are following the social distancing guidelines and everything of that nature. And keep good track of what you're doing in that regard. And that way, if someone claims to have contracted a disease when at your premises, you can say, well, we followed all the guidelines, we were in no way negligent, and there's no claim. What I think is going to be difficult in these particular instances, that's going to be very hard for someone to prove that they contracted an illness at any one particular place of business. This is not like food poisoning where you ate at a particular restaurant. Once people start venturing out, going to restaurants, going to other businesses, they're probably will have been at many different locations, And it'll be very hard to come back and say, well, I know that I caught the disease at X place or Y place of business. So, but in order to protect yourself and just think about it, just make sure that you're following the guidelines as set forth, and that to the best that you can, document what you're doing on a daily basis to follow those guidelines and to keep your premises clean. And that's all I have. So I think we can probably have about 10 minutes or so for questions.
Okay, I think I'm unmuted. Joanne, if you can unmute the rest of the panelists.
Yeah.
Thanks. So if there's any questions that anybody has, you can put it in the chat room. There's one question that was put in the chat room already, which I'll just read. It says, I have a client who will make 75% for the payroll, but they will not make the 25% of the utilities/rent portion of the PPP loan. Will they need to pay back the difference or the 25%? So the full amount of the PPP loan is eligible for forgiveness. The forgiveness amount will be equal to what your payroll costs are and can include those non-payroll portions for utilities and rents. Hi, Karen. And, provided that you use the payments in the next 8-week period from your receipt of the funds. So you have 8 weeks to spend it on those payroll costs and those utilities and rents. And you can deduct the full amount of what you spend for those eligible purposes. If you don't meet that threshold, if you don't have enough of those expenses to get to that 25% or that 75%, you can either return that balance and not owe it in the future, or it will be considered a loan at the 1% interest rate, and you have to repay back that portion of it over a 2-year period. It's really over an 18-month period because there's a 6-month period of forgiveness of principal and interest, the deferment of principal and interest. So hope that answers your question.
Yes, thank you. I'll tell them.
You're welcome. Any other questions? Quiet bunch today.
It is.
Okay, well, don't want to keep it open. Oh, there we go. Liz Lawler says, I received the PPP funds on May 6th. I assume I will be unable to use the funds fully. A 501c3 does not pay rent. Can I return a portion? You can always return a portion of your PPP funds.
Hey, I'm Rick. You could also always prepay that loan to the lender of record too.
Right, you can prepay the loan. You can,
right, with no penalties. So.
Right, there's no prepayment penalty, so you can always prepay it along that 2-year period, that 18-month period, or you can return it. And if you do that, if you return all of it by May 14th, there's just kind of like no questions asked, and you're deemed to have truthfully and honestly answered the set forth your eligibility criteria. So there's no questions of its use at that point. Hope that answers your question. I don't know if anybody else wants to chime in on that.
See the question? She asked, can we repay by sending a check to the bank?
Yeah. I'm assuming that's how you would repay. Yeah. Got a few others popping in here. Please review SBA 6-month forgiveness terms. Do you have to apply? So if you have an existing SBA loan, you do not have to make any application. The SBA should have already been talking with the lender, with your bank where you got the SBA loan, and should be paying your principal and interest payments monthly now. I think they started in April. And certainly in May. And so those payments are made directly by the SBA to the bank on your behalf for your SBA loan. So that's what's happening with existing SBA loans. If you apply for a new SBA loan, that same 6-month forgiveness is applicable to new SBA loans that are made in the next essentially 6 months between now and September 27th. Are the contributions to the pension plan also included as payroll? That's a really big question that a lot of people are asking. And Don, I don't know if I'm going to throw you out on that one, but I think we talked a little bit about this, pension plan payments.
So I think it's clear that current employer matches paid during that 8-week period to the profit sharing plan and trust are allowable expenses for purposes of the 75% payroll rule. What is unclear is whether you have a accrued 2019 employer contribution and you want to pay that in that 8-week period. That is totally unclear. To some extent, that's contrary to the congressional policy of funding current payroll in that 8-week covered period. So until we get guidance from the SBA, I'm not able with any confidence whatsoever to advise clients to use that loan proceeds for the 2019 accrued employer contribution. We just don't know. And so I would tend to be rather conservative there, especially given some of the other SBA guidance that's been promulgated. So be very careful. Hopefully we'll get some clarity in the near future, but for now, unless it's an employer match, I don't feel comfortable with any other accrued pension or profit sharing plan liability.
Any others there, JB?
I don't see any coming in on the chat, and I don't have any on email.
Okay. Well, we got a couple minutes left. See if anybody says anything, but appreciate everybody joining today. And I appreciate Joanna and the chamber, hosting these. These have been very good, not only for the businesses involved, but it's been good for us as well to kind of reach out to the business community and help out where we can.
We did have another question pop up from Karen. How do you document draw as an expense?
For a self-employed individual, essentially, for a small
Karen, I'm
LLC.
going to unmute you for a minute. Karen, you're unmuted, so you can ask the question.
Thank you. It's better than typing. Yeah, well, we do have some draw for some self-employed people. And even though it's on the books, how do you keep track of it in the general ledger to make sure that there's a clear audit trail for the PPP loans and their payroll expenses? At this point, I'm only keeping them on Excel because if the PPP loan goes into the operating bank account, that's great. We could set up a liability as a loan payable until it's not payable. We can do that on journal entry. However, the payroll is done in the rest of the journal entry, and the draw for some of the self-employed is obviously on the balance sheet, but we need to keep that very clear.
All right, let me address that. First, if any draws paid to a partner or a consultant or an independent contractor, hopefully is done in accordance with historic practice, and you have an underlying contract that provides for the draws. I wouldn't advise anyone to do an extraordinary bonus, but if you could, if you pay out that draw, again, if maybe a guaranteed payment to a partner or a share or a S Corp member, that's fine because that's guaranteed. That's a guaranteed payment, so that's tantamount to salary. But just document it, and again, the self-employed is going to be responsible for the resulting self-employment taxes. But I think if you do it within historic practice during that 8-week covered period, you should be okay, Karen.
Okay, thanks.
I hope I answered that adequately.
The only thing that I would add there is just make sure that the amount of the annualized draw doesn't exceed $100,000, right? Because
correct.
That's not eligible as a payroll cost. The amount's over
Right.
that.
Right, thank you.
Yep, you're welcome. Last one, can 100% of the PPP be used for payroll? You can, well, Don, I think you can use 100% payroll. Only 75% of it is eligible for forgiveness, though. Is that correct?
No, I think you have to at least use 75% to be eligible for the forgiveness. I think you could use it for 100%. I think that's fine.
Right.
Again, the 75% is the threshold of forgiveness, not on use.
Correct.
I think Karen has another question.
No, I'm good.
Okay.
Anybody else? Want to be cognizant of everybody's time. It's 3 o'clock now, so thank you for joining us. Johanna, thanks for hosting this again.
Yeah. Thank you, guys. And don't forget to check out UKS's website at www.uks.com. You can find all their email information there along with their telephone numbers. And it's a great resource of information. So thank you for joining us. We'll see you guys in 2 weeks, possibly. So appreciate it. And everyone have a great day. Enjoy the sunshine today. Thank you.
Thank you, everybody.
Bye.
Thanks, everybody. Bye.